Trading 212's Pie feature offers investors the chance to easily build their own portfolio of stocks, funds, bonds, and commodities. But before you even start to use a pie from Trading 212, you're faced with a big question. Would you like to make your own pie, or do you want one that we made earlier? If you're new to investing, then the ready-made pie might seem appealing, as you can simply copy a portfolio from someone else, which is given to you without having to gain the knowledge of what to invest into. But is that really a good idea? Trading 212 features a selection of their own pies and community pies too. So let's take a look at some of these ready-made pies and see how they shape up. And if you're new to Trading 212 and didn't yet claim your free share worth up to £100, don't forget to go to use promo code in the menu and add promo code FIN, that's capital F-I-N. As soon as you select the ready-made pie option, you'll see Trading 212's model pies. At the time of recording, there are 5 different model pies that you can choose from. The first 2 we'll quickly look at are BlackRock Core and Wisdom Tree Core, the top 2 portfolios featured in this section. BlackRock Core is made up of 49% equities, that's stocks and shares, 48% government bonds, and 3% commodities. And this includes things like physical gold. Somewhat similarly, Wisdom Tree Core invests in 48% equities, 32% bonds, and 20% commodities. Both of these pies aim to be globally diverse and slightly lower risk than some of the pies we'll look at shortly. And they aim for diversification by spreading money across different asset classes and industries. Now, seeing as I'm looking to invest for the long term, say 30 years or more, I have a lot more opportunity for taking on a slightly higher level of risk. What I mean by this is that bonds and commodities aren't that appealing of an option for me, at least at this stage of my investing journey. Right now, I look to have my investments as close to 100% in equities or stocks and shares, as they have the potential to yield higher returns, especially over a very long investing timeline. But obviously this approach comes with more risk and price volatility as well. As you can see, these 2 model pies have relatively low exposure to stocks. Bonds are considered to be much safer investments, and therefore you'd be more likely to invest into them once you near your retirement age, to make sure that your portfolio value doesn't fall at the last hurdle, or if you just want an asset class that is considered to be much lower risk. So if you're in that situation and would prefer your money to be at less risk at the cost of potentially lower upside, then these could be good options for you. All of Vanguard's target retirement funds contain bonds, usually starting somewhere around the 20% mark and increase as high as 70% as you reach your target retirement year. This shows that popular long-term retirement investment options still contain bonds. However, they're not what I'm looking for right now, so these 2 model pies don't really interest me. However, if you click through to the pie, you can select an investment style, listed in Trading 212 as Pie Variant, which will change the investment ways. So if you wanted the most conservative pie possible, you'll be putting nearly 78% of your investment into bonds, and then only 20% into equities. However, on the other side of things, you can select aggressive and have 92% equity, so there is flexibility for you to consider. But we don't have time to analyze every single pie option in this video, so we're going to stick with the default options, which is the moderate pie variant. I'm not an investment analyst or a financial advisor, I just know what I want to invest my own money into, and neither of these pies offer what I'm looking for. Ignoring those 2 pies, scroll down a bit and you'll see 3 more model pies that do invest 100% into equities. And again, that's just a fancy word for stocks. These don't have the option to alter the investment style, as they're already fully maxed out on the risk side of things. But you can look through what each pie is composed of and get a good idea of what it invests into. Actually, you won't need to look, because I'll just tell you. The Wisdom Tree Tech Pie will invest your money into multiple ETFs, all in different parts of the tech industry. This includes artificial intelligence, blockchain, and biotech, and is basically a futuristic tech pie. The type of pie you'd enjoy sinking your teeth into as the world just burns around you. There's also the Wisdom Tree Environmental Pie, which focuses on eco-friendly themes like renewable energy, recycling, sustainable food, etc. And finally, there's the Wisdom Tree Multi-Thematic Pie. I've not given my thoughts on these pies yet, as I can summarise all of my thoughts together. The multi-thematic pie seems to basically be a mix of the environmental and tech pies that we just looked at. You're able to dive into the specific funds and see all of the areas and companies these pies invest into, but there's a big problem in my eyes: overexposure to specific industries. Like I said before, I'm happy to take on higher levels of risk because of my age and long-term investing timeline. However, the reason I look to invest in funds is to ensure I'm diversified. Basically, I don't believe that I have the skills to identify which different stocks or sectors will increase or decrease in price. Investing in funds that focus heavily on one area is essentially stock picking. And yes, obviously I think AI and emerging technology will be more prevalent in the future, but so does everyone else. The fact that these things are going to explode in popularity in the coming years is already factored into their share prices. The other thing with these pies is that the yearly fees the funds take, and this is called total expense ratio on Trading 212, but is also referred to as ongoing charge in other places, are really quite high. The more niche the fund you're investing into, generally speaking, the higher the fund charges will be. Wisdom Tree Environmental, for example, take a 0.6% annual fund fee, plus other small fees for trading costs. This is a lot higher than many other funds, and the difference between a 0.6% annual fee and a 0.22% annual fee, just as an example, can be significant when compounding fees eat into your balance over time. Whilst the initial model pies were too diverse in terms of asset classes, with me wanting to focus on stocks and shares, the other model pies aren't diverse enough for what I'm personally looking for. And what you're looking for might be totally different depending on your age, risk tolerance, and more. So the first pies were too cold, the second pies were too hot.
It's hotter than the sun!
But will the final pies we'll look at be just right? A pretty cool feature that Trading 212 offer is their community pies, which allow users to essentially copy the investments of other real users and upload their own for others to copy. You have the option of selecting between the top community pies and new ones, and as you can see, there's a diverse mix of portfolios on show. I'm not really sure why, but the default filter here is new pies, so it doesn't show off the most popular, it shows off what's rising in popularity despite being fairly new. The top result on this tab is currently a GTA 6 build-up pie, which consists of companies that will be affected by the release of the game. So Amazon, Sony, Take-Two, who are the publishers of the game, and other similar companies, even including the notorious GME to round off this meme-worthy portfolio. Of course, this is quite a fun and topical option, but certainly isn't built with the long term in mind, so again, it's not suitable for me. We can then skip past AI growth, the Donald Trump USA portfolio, which includes 34 companies expected to do well if Donald Trump is elected, and a whole load of other community pies for reasons we've already discussed. Unsurprisingly, if we change to top pies instead of new, things look a little better. Take the top pie for example, which focuses on big brand names that pay dividends like Microsoft, Apple, etc. This is clearly a popular one, as 110,000 people have copied this pie at the time of recording, but it's again not a good fit for me. It only includes 50 different companies, so it's not particularly diverse. And it invests exactly 2% into every company, so it doesn't scale based on company size or market cap. As a long-term equity investor that doesn't want to pick stocks or industries or regions, I want my portfolio to include a lot more than 50 companies. I want the investments to scale based on the size of the company. The bigger the company is, the bigger my position is, ever so slightly. And I also don't want to limit myself to companies that pay dividends like this pie does. Also, seeing as I live in the UK, I'd be paying FX fees for buying individual shares that are priced in dollars, as opposed to investing into an ETF which is priced in Great British pounds. So for someone like myself who wants to build a huge and very diversified portfolio of shares, an index fund tends to be the best option for me. But that also depends on the fee that it charges, of course. And if any of the pies that aren't right for me seem exactly like what you're looking for, then that's great. Hopefully you can tell from what we've spoken about so far that it's really important to know what you want to invest in and why. And if you're unsure about anything, speak with a qualified financial advisor. Based on what I've seen from the different pies on offer, I personally don't use any of the model or community pies. I use the create your own pie option, and in fact, the only reason I use a pie in the first place is because it allows me to set up regular ongoing investments. At this time, within my pie, I just have a single solitary ETF. It's a global all-world fund which invests into 3,727 stocks as of the date of recording this video, and has an ongoing charge of 0.22%. These stocks are from companies across the entire globe and includes both mid to large cap businesses. Also, any dividends that are earned are automatically reinvested because this is an accumulation fund. Hopefully from everything I've spoken about in this video, you'll see how important it is to decide exactly what you want from your own investments, rather than blindly copying what other people are doing. And that includes me. I am other people. And I'm not an expert nor a financial advisor.
We're just normal men. We're just innocent men.
One thing that's confusing for new investors is how hard it is to easily see what each fund does. So if you're looking to find the most popular funds across various leading brokers, including Trading 212, I've linked a free cheat sheet in the description below that should help. And if you want to simplify the complicated words that pop up in investing content like this, you need to watch the next video that's on screen now.